Your view on our manufacturing output, just for starters?
Well, it's a pretty volatile series, let's remember, and there was clearly a large bounce back from the previous month, mainly on base effects. But the number was broadly on my forecast. I was looking for 1.1, surprised the market somewhat to the downside. I think it's more interesting looking at the breakdown, actually. We see export-related sectors not doing very well at all, particularly things like metal and mineral processing. Textiles as well, actually doing not very well overall compared to the progress of the last few years. So definitely signs of an underlying slowdown happening in this data, even despite the tick up from the previous month.
We also had data out today on the business confidence index, and a big slump, particularly in business confidence in manufacturing, partly because of political reasons. What's your assessment of how much chief executives are depressed by politics in South Africa, and how much it is to do with demand and likely demand in Europe, for one?
Well, I'm not sure the political situation has really changed significantly this year or in the last couple of years, to be honest. So I'm not sure we can label too much of it on that. I think, as we saw actually in the 2008 sort of period, the basically global events and global crises generally hit South Africa with a slight lag, and we're now seeing basically the Eurozone sentiment shock, feeding through to South African executives. And the ones I speak to certainly have got much more bearish much more recently. Whereas, when I talk to executives in Eastern Europe, they get bearish, it seems, much faster around these sorts of events. And I think, we saw in the PMI numbers as well, out at the start of the month, that the turnaround in new orders has already started to come through as well. So all pointing towards this much greater slowdown, I think, in South Africa than many people are currently expecting in their forecasts.
Emerging markets generally, in the light of what's been happening in Europe. We've had 2 days of quite strong rallies on the stock exchanges from the east right through. Lots of green boards, as we say, showing those increases, and it's been continued today. Now, they were expecting a rate cut from the European Central Bank yesterday. That didn't happen, but noises about possibly being easier in the future. Ben Bernanke talking today and noting a lack of confidence in Europe. So where do you see this going, and how is it going to affect the emerging market investment perception?
Well, the market rally at the moment looks pretty unsustainable over the medium run to me. I mean, what we've basically seen is the start of the rally based on cuts expectations and the continuation of the rally around some form of bailout for Spain coming through and for the banks. But none of this really addresses any of the real issues, which are all structural. At the end of the day, we're simply pumping more money into the problem without getting a proper fiscal union, proper banking union in particular, which is needed in the short run. So I think basically any rally back may continue for another couple of days, even weeks, but we are waiting for that Greek election to come as the main event. And after that, regardless of the result, we will see that the situation in Greece is totally unsustainable, and with that a high possibility that the Greek exit can come through the end of this year.
A couple of events that have happened. Yesterday we had the G7 conference, which not much came out of, but there has been a Chinese interest rate cut, apparently surprised some observers, 25 basis points to 6.31%. And the Bank of England left the rate as it is at 0.5%, feeling that there's no need to get more money into Europe. So those are two hard numbers. What will the effect be of that?
Well, people totally overestimate the impact of the Chinese monetary policy on the Chinese economy. Basically, the Central Bank of China works through, the PBOC works through basically quantitative measures restricting or relaxing the supply of credit through reserve requirements and through direct instructions to banks. And of course, there's a ginormous shadow economy in lending in China as well. So the impact of a rate cut on the economy really is very slight, and it is a boost perhaps to sentiment slightly in China, but we really don't read that much into it. In terms of the ECB and actually the BOE as well, we think there will be further easing coming forwards, but that's probably only going to be after the Greece election, after things get worse in Greece and in Spain as we go forward. So we actually expect a cut from the ECB in July, and we expect further BOE, QE to come sometime through the second half of the year. And those events, of course, will be very important for EM currencies like the Rand.
You mentioned Spain, and I saw one statistic that the servicing of the debt on Spanish banks doubles by the week, or something equally enormous. What will happen with Spain in particular?
Well, we're all basically waiting to know what the size of the hole in the Spanish banking system is. The IMF puts it at around 40 billion currently. I think the official government number is something like 30 or so. But actually ourselves, our banking analysts are extremely bearish on the situation in the Spanish bank system. We think the hole in the system could be up to 200 billion odd as we start to see the numbers come out to light. And we're all waiting for this Oliver Wyman report to come out, a detailed study into the situation of capital and assets on the Spanish banking system, and that will give a truer picture. But that will show basically the stress that Europe will come under to try and bail out the Spanish banks when that sort of money is demanded.
That was Peter Attard Montalto, who's emerging markets economist at Nomura International.